Frank Fabozzi. The CFA Institute Research and Policy Center brings this series to you, and I'm Frank Fabozzi. My guest today is Chris Vella. Chris is the CIO at BNY Advisors, which is part of BNY Investments, where he is responsible for an investment team focused on providing solutions for intermediary and institutional clients. Prior to that, he spent 2 decades at Northern Trust Asset Management, where he served also as the CIO of multi-manager investments. He's a CFA charter holder and earned a BS in finance from Lehigh University. Welcome, Chris.
Thank you, Frank. Great to be here.
Same here. Tell us about your journey to becoming the CIO at BNY. What key experiences or roles have shaped your approach to leadership?
Sure. No, I appreciate this experience to come and spend time with you. So my journey started at SEI Investments many moons ago as a research analyst covering international and emerging market equity managers. I did that for a little bit over 5 years. I went to Goldman Sachs and led that research effort in the same asset classes. And after about a decade of doing that, went to Northern Trust to really expand out into the other asset classes, become head of global research. Spent a decade basically head of global research at Northern Trust, and then spent a decade as a CIO for their multi-manager, multi-asset class business before coming to BNY a couple of years ago. I'll say these experiences, the way they shaped my approach to leadership, for decades, if you think about it, a key part of my job was to identify the best money managers in the world. It gave me a unique insight into some of the characteristics that worked well within successful asset managers, and frankly, those characteristics that really did not work well with some asset managers. I would always tell my research team that any meeting you had with the manager is something you're going to learn about. And there were some key takeaways, even in some pretty disruptive and interesting and organizations as well. But I'd say that for the most part, some of the key takeaways as I experienced that the importance of a strong culture around investments was really critical. A disciplined approach to portfolio management was also something that it was apparent in every one of these successful organizations. And then also allowing for a leadership style that allows for innovation and creates a team environment where everyone works well together. Those characteristics, it's easy to talk about. It's easy to say these are the things you aspire to. Very difficult for asset managers to demonstrate that and to implement it within their organizations. And for me personally, those have been my takeaways to try to create those types of environments within BNY, within all the organizations I've worked in the past.
Yeah, that's one of the reasons for this series, because we spend a lot of time, and when you take the CFA exam, the focus is on understanding the analytics, the products, the strategies. There's not as much time spent on understanding leadership. So we've been doing a lot of that in the series as well as in articles. What drew you to BNY Wealth Management, and what excites you about your role?
Yeah. So BNY, founded by Alexander Hamilton, 240-year-old bank, a rich history of innovation. You don't become 240 years old and not be able to change and innovate throughout the history of an organization. It's one of the world's largest asset managers, over $2 trillion in AUM, $50 trillion in assets under custody. The firm is a trusted fiduciary on a global basis. It's an incredible organization. There's an intense focus on placing clients first and being client obsessed. My opportunity within BNY was to come in and lead a team that was advising both institutionally as well as on the intermediary side directly with private wealth clients, which was really exciting. And for me personally, to bring the expertise of asset allocation, private markets, traditional manager research to all of these types of different client types was exciting. But what excited me the most, I'd say there are two real factors that really interested me the most in terms of BNY and what we're doing here right now. One is the just working within this intermediary space and the private wealth arena, um, and doing that through Pershing and doing it through the intermediary arena is really exciting. And the expansion of alternatives and the focus that we have on alternatives. These are the two fastest growing and most dynamic segments of the investment industry right now. And for me personally, I'm humbled to be working with such a strong team of investment professionals to kind of bring this expertise to our clients in these areas. So that's really what attracted me over to BMY.
Now, I actually forgot it was Alexander Hamilton who started him. I haven't seen the play yet, but I don't know if they talk about his starting of BMY. But how would you describe your overall investment philosophy?
So
Have
yeah,
there been any significant changes in your approach over the years?
so from an investment philosophy perspective, we believe that pretty basic. We believe behavioral biases will create market inefficiencies. And if you're implementing a disciplined risk managed approach to portfolio construction, we can capitalize on the inefficiencies for our clients. We keep it very simple. And that's some of the beliefs that run through all of our portfolios and our client portfolios. In terms of significant changes over the years, I would call it enhancements, like personal, enhancements through innovation. Yeah, I feel like you think about risk management as one example of this. There have been so many changes over the whatever 3 decades I've been around doing this, and it's moving from spreadsheets to detailed portfolio performance return analytics to holdings-based analytics, and now AI, and there's this advanced math behind the data pools that we have that we have access to. So I think that taking a relatively basic and straightforward investment philosophy, but making sure that you are being aware and frankly incorporate the changes that take place in the industry overall into what you do every day for your clients is absolutely critical.
How do you balance short-term market pressures from your clients with the long-term investment goals that they have?
Yeah, with great care. So I'd say that uh, okay, an investor can't ignore the short-term market pressures, um, but it's absolutely critical to stay focused on the long-term goals and objectives. I mean, we spend a lot of time upfront understanding goals, objectives, from a risk tolerance perspective with all different clients, institutional as well as private wealth clients, um, as well as different elements of what's going to come into play, like liquidity in a portfolio. So, from our perspective, you have to make sure you keep a lens on that long-term goals and objectives for every one of your clients. At the same time, as an investment team, we're getting together on a weekly basis. We're getting together on a monthly basis. We are setting our strategy for each client, but then we will have a tactical view, and that tends to be for us 12 to 18-month perspective on the market environment and how we may tilt portfolios to take advantage of different environments. So the bottom line is every client has a strategic long-term goal objective that helps us create a target portfolio for them. And as investors, we need to make sure that we are aware of what's going on in the market environment and then very thoughtfully and in a disciplined fashion, getting back to discipline, tactically shift the portfolio exposures with an eye on a 12 to 18-month view for the portfolio.
What are some major investment trends or opportunities that you see and your team, and that's when I say you, I always mean your team,
Yeah.
should in the market in the next 5 to 10 years?
So, we just published our capital market assumptions paper this week. So we do it right before the end of the year, get it out into marketplace. It takes a 10-year perspective on the markets from capital markets, about uh, 50 asset classes, 4 or 5 different currencies. It's a huge endeavor for the entire team. And within the paper, upfront, we identify a number of the key trends that we expect will shape the markets over the next decade. And I'll mention a couple. I think there are two worth highlighting out of the ones that we're looking at. But and these probably won't surprise you too much. but I think they're going to be significant for investors. The internet back in the late '90s, right? We've got AI, and I'm sure all of your listeners are very aware of AI and what's going on there. From our perspective, this continued adoption of AI across many different industries is going to have a very similar impact, if not more a more meaningful impact than the internet did in the late '90s, and that goes beyond semiconductor manufacturing, NVIDIA, electric industries, goes way beyond that. It impacts almost just about every industry out there, and from our perspective, should lead to higher revenue generation and a lot of cost savings, which is going to be important for global equity markets more broadly. So that's one key trend that I would highlight. The other is and again, we've seen this over the past couple of years really pick up in ways, and it won't surprise you, I think, either. But it's the demand for alternative financing away from traditional banks, and that's led to a huge rise in the private debt industry overall. And we've really seen the private debt markets kind of step into areas that traditional banks have stepped away from. We feel that this is something that will stay within the markets. It could potentially expand within the markets, and net, it's offering some very attractive yields for income investors. And hopefully we'll talk about this a little bit later. But the innovations that are taking place within sort of the alternatives world, that's something that I think will be pretty pervasive in this space. It'll allow for the democratization of alternatives more broadly. So private wealth investors of all different sizes and types will start to get more and more access to these types of investments. And we think that has some staying power as well over the next decade.
Yeah, we'll return to that. I mean, discussion of alternatives. And what I spend a lot of my time on is actually looking at the private debt market. I think that's the second fastest growing sector within the alternatives area. And the CFA Institute has a keen interest in it. We'll probably have a panel discussion on it sometime in the future. And if you'd like to get involved, just let me know. How do you evaluate and select investment managers? Because that's what you spoke about earlier. What key attributes or metrics are you looking for?
So I could spend an hour easy just on this topic alone, but I'll save your listeners going through a lot of the detail. But there are a lot of there. I'll go through a few of the key factors that I think that help any investor identify true skill in money managers. It's not an easy skill to have. It's not easy to identify, frankly. And it's a rare skill as well. I'll tell you one of the most important though attributes when you're doing this type of analysis. It really comes down to who's looking at this information. So before you even get into what creates like a great investment strategy and an amazing investment in a strategy and a team and an organization, the folks who are actually the research analysts that are evaluating these factors, when you have a highly experienced and skilled team looking at these factors and making these decisions, these qualitative decisions, that's what makes the difference between a really great investment and potentially some mistakes. We've got a great team here, decades of experience for each of these individuals on the team, which is quite rare in the industry. And what are they looking for? It starts out with a strong foundation, like a lot of things. The organization itself is really what keeps investment talent and in place and stable. Positive work environment, and what I started off with, the investment culture within an organization is really, really important. And assessing that, it's something that doesn't often come down in just the paper, the words that you're reading from an RFP response. It really comes down to visiting with teams and visiting with organizations on site. You have to have a really experienced team making these investments. You have to have an experienced team that's worked together, that has depth and breadth of investment acumen and capabilities. And then the disciplined investment process. I get back to that discipline. Discipline is absolutely key. And how do you know when a process is truly disciplined or one that is not? A lot of it comes through in the portfolio itself. And you should be able to, a really good research analyst can take a look at a portfolio of investments and know in certain market environments if they're going to outperform or underperform the market. mean, that's critical. And the only way to have that kind of confidence in basically in the end results of a portfolio strategy is it as a disciplined investment process that's behind that portfolio itself. So making sure that you're really drilling into the process itself and the outcomes that it creates. And finally, you know, the proven quantifiable track record is absolutely critical. I mean, you need to make sure that it all comes down to performance and execution of investment strategy. A successful track record is critical for a long-term future, looking out into the future success for an investment discipline. The one thing I'll end on this area is everyone typically gravitates to what I was talking about in terms of the investment due diligence side. We have an operational and compliance due diligence side, an ODD team that's looking at investment managers alongside the investment due diligence. So our operational and compliance due diligence, no manager makes it through our process, and a good process. No manager should make it through any good process without a full assessment on compliance, on operations, all the things that, if there's a hiccup, it could be absolutely disastrous for an organization or firm or strategy. So we take it the tactic, where there is potential smoke, there could be fire, and it's quite a conservative approach. But you want to make sure that managers are operating, above the industry standard and doing everything they can to have a culture of compliance within the organization.
You know, why don't you've been mentioning the different specialists in your group. Tell us about the organization. How is it structured? The relationship amongst the different groups or specialty groups.
Yep.
Can you do that?
Sure, absolutely. And again, that's it's one of the unique things that we've been able to build and bring together here at BNY. It's rare. Oftentimes, you'll see organizations with a private markets team off doing their own thing, research team doing something in three different spots of an organization, and then asset allocation all over the place as well. We've really brought all of this together under one umbrella. So the way the team is set up, we have a group that is focused on, we call it the Investment Institute, that's focused on asset allocation, everything from capital market assumptions I described earlier through to strategic asset allocation and tactical asset allocation. That team is responsible for just that. Over a dozen people just responsible for that. We have a traditional manager research team that looks at well over 800 investment strategies, investment managers, and they are broken up by equity, fixed income, and the real assets category as well. And then we've got a private market team, and the private markets all within the same group. And the private markets, private equity, private credit, real estate, infrastructure, everything you can imagine in the private market space, that team is dedicated as well. Our operational and compliance due diligence works with both the traditional and the private market teams. And then we've got two other groups that are more client facing. We have an outsourced CIO team that is focused on our institutional investors, foundations, endowments, defined benefit and defined contribution plans. And we have an intermediary solutions team focused strictly on on model portfolios for a lot of our intermediary clients as well. So they're doing the whole portfolio management across different risk portfolios and risk spectrums and different client needs on the private client and high net worth side. So that's kind of the structure of the overall team. We've got about 80 professionals covering about 180 billion in total assets.
You have only 80 covering that, and I assume that includes your marketing group, or is that
That
just
includes includes some of the market, includes some middle office as well. But yeah, that's the total team.
we often, or too often, neglect the importance of operational people. And you've mentioned several times their key role. You want to repeat that again? I mean, what do you mean by operational? What opportunities there are in that area, or what they do, how they serve the rest of the team?
So yeah, so there's the couple of aspects to that question. We have our middle office group, our COO, and our middle office team that is responsible for making sure that as we bring clients on, the execution of those clients. We have a transition management team. We ensure that a client will come on in a seamless fashion, no hiccups, nothing. We're able to connect to potentially different types of custodians, things along those lines from a COO perspective. trading as well. A lot of that's outsourced internally within other parts of BNY. Some of that's within the group. But there's a lot, and then there's risk oversight as well within that group, within that middle office team, investment risk oversight. We also have an operational due diligence team, which will look at the outside money managers, and those individuals will be responsible for evaluating policies, procedures, the operations team of the outside managers. It's to ensure that there is good risk discipline on all of these different types of strategies. Private, like I said before, private market arena is really a strong focus for that team because there's less information that's public information. A lot of it is not public. A lot of it is going through DDQs and our own DDQs, interviews with the managers, understanding the investment strategy, how a team will implement that strategy, and ultimately, auditing of the strategy, the profile of liquidity, and the nature of liquidity for the strategy, and execution around that. So a lot of different facets to it. And again, like I said before, on the investment side, the ODD side is the same thing. It's difficult to take someone who has a few years of experience and just kind of plop them into an ODD role. You really need to go into that with, decades of experience or a decade of experience having done that, having gone through the interviews with different managers to really be able to identify where there's potential risk, where there are issues to for us to stay away and avoid a potential disaster for our clients.
Well, you mentioned risk management. How do you approach risk management for your clients?
Yeah, so start with the basics. Diversification is really important. So you may making sure that a client is well diversified across asset classes, across types of investments. If they're able to different liquidity profiles to really ensure a robust portfolio. And we also the other key component to the kind of the risk management, want to make sure that we're assessing risk through different types of measures. One of the riskiest things could be simply having just one single risk metrics that you're so focused on. So we want to make sure that we're looking at absolute risk, whether volatility measures of risk. We want to make sure we're looking at relative risk, information ratio types of risk metrics. We also want to make sure we're looking at holdings-based risk analytics, correlations across portfolios, and factor risk analytics. So it's really you're creating like this mosaic, this picture, if you will, of a portfolio risk assessment, understanding different parts of the market where you want to. The most important thing is you don't want to be surprised, wake up in the morning and something came out of left field that you were not that you completely missed from a risk oversight perspective. You want to make sure that when we get together as a team from a weekly or monthly perspective, and we're making tactical bets in the portfolio, we want to make sure that those tactical bets align, the risk management, the risk oversight aligns with those tactical bets that we have in the portfolio. The worst case scenario is something happens in the markets and it hits a lever that you weren't aware of in the portfolio overall. So we basically dissect these portfolios every possible way to ensure that doesn't happen.
Yeah, yeah, that's all was always my concern when I served on board is, I just refer to that as risk, the risk that you don't know what the risk is. But, you know, there are, do you have a specialized group that oversees all of the funds that quantitatively puts all of this information together for both your portfolio manager and your clients? Is the right term a quant group?
Yeah, right. Yeah. We have some quant specialists within the team. I'd say that it ends up falling out into a couple of different roles, whether it's in the middle office side. We've got a risk management oversight team as well. From an investment risk perspective, they're playing a role in that. And then we have some specialists on the different research teams that have done a lot on the quantitative side in terms of machine learning, AI types of things that we're trying to incorporate into different elements of the process. So for now, it's kind of split into different areas. We have not gone down the path of just having a quant research team, not yet.
This quants that you are, you know, what backgrounds do they have? I'm sure you don't have their resume in front of you, but
I don't. No, that's all good. No, but you're right though, and I think that we've got a couple of people on staff that and are looking at some PhD hires that would be nice additions as well. We've got a part of our asset allocation team has they've taken there's a quant analytics group within, there's a quantitative bias within that team itself. So we got a couple of people who have who've had pursued their PhD, have gotten their PhD, and that's two so far right now. And I think that's important to have access to. Being part of BNY also, I wouldn't want to minimize the fact that we've got the ability to kind of tap into other parts of the bank and other resources that a lot of other groups really don't have access to. So if we ever need to really do a project on a specific area, whether it's analytics or quant research, there are parts of the bank that we can tap into that would be able to help us out, and do a phenomenal job at it too.
What roles do alternative investments play in your overall strategy for wealth management clients?
So, yeah, this is one of the areas, I'd say in the market overall that is changing the most. Yeah, I'll talk a little bit about how we think about alternatives, and then I'll spend a little bit of time on where I see some of the innovation, if you will, in sort of product development in the space, which I think is important. But from our perspective, it's really important to put alternatives in the context of the entire portfolio. That's really key. So not to completely dissect it from your traditional equity or traditional fixed income allocations within a total portfolio, but to think of everything from a total portfolio lens. And there are three key areas that we feel a lot of the alternatives, like three key uh, I'd say ways that they complement a traditional asset class portfolio for a private investor. One is risk reduction and diversification from that perspective, and a lot of that will come from your hedge fund allocations. So when we think about a risk reduction element, oftentimes that'll go in the portfolio, in the equity allocation of a portfolio. It'll be allocating assets to particular hedge funds that complement the traditional asset class itself. And what do hedge funds bring to the portfolio? Oftentimes, you need to really understand the details around each of these strategies. But the risk management strategies, the short selling, the derivatives, market neutral approaches, all of those lead you down this path of basically diversification during market turmoil or market downturns, and reducing the overall portfolio volatility and adding a different element of portfolio alpha that a straight up traditional long only portfolio is missing oftentimes. So I think that's one area. Another is enhancing returns. So when you think about enhancing portfolio returns, the natural here is something like private equity. Again, in the equity allocation of a client's portfolio, private equity gives you a little bit of that illiquidity premium that we would expect, which is important, and we feel there is some true illiquidity premium that's allocated to that asset class. We also, though, feel that you gain access to very unique opportunities in the marketplace overall. And so I think there are parts of the public markets which just don't have the same type of exposure to certain areas that the private equity markets are actually investing in. And AI is a great example of that, frankly. AI technology, has been, a good place for, private equity funds to make some early stage investments. And you know how that game kind of works is if you're making 10 of those investments and you get a couple that are home runs, it makes a big difference in the portfolio. So I think that's another element of the alternative portfolio we're thinking about. And the last one that I'll mention is enhancing income. And that's gets back to the private debt markets. And a lot of what we've seen in basically the structural changes in the credit markets over the past 5 years, over the past 10 years. And there are a lot of interesting opportunities there for clients to increase or enhance their income. And it's not just private credit. You think about private infrastructure, private real estate, all of those areas of the market that are much more part of the fixed income allocation from our perspective, and part of that income generating portion of the portfolio overall.
Yeah. Tell me your experience with the private debt. I'm certainly interested in that.
Yeah. So far we had some successful investments, and it's worked. So yeah, right. So so that's a good thing. I think that we're at a point now where there is a significant amount of money obviously flowing into that space. It would our expectations is that the what you've been able to generate in terms of income over the past 5 years is likely not going to be the same level that you will experience over the next 5 years. So we feel that that's, there's going to be some compression there. But so far it has been, for our clients, it's been a successful part of the portfolio.
How are you integrating ESG considerations into your investment strategies? Or is that something that's imposed upon you by your clients?
So, at times, I guess it's a little bit of both. We have clients who are looking for, obviously some clients are looking for responsible investing, sustainable investing, ESG, whatever you may call it these days. Lots of different names for I think the same similar outputs. We've got one person on the team specialized on responsible investing, and looking at that from a research perspective. We when we think about ESG, there are four buckets that we would place different strategies into. The first is an integrated investment bucket, like ESG integration. So we have we've got managers who look at ESG factors in terms of every investment they're making. So, we have one of our affiliates, Walter Scott, does this within their design of a portfolio and the investments that they're making. They are integrating these ESG factors because they feel long term it's going to have an impact on the total return of the companies that they're investing in. In their case, long term equity markets. So it's almost really a full fledged. You have managers who have completely moved into taking ESG into account whenever they're evaluating every investment. That's that integration portion. There's another bucket is either screening investments or tilting investments in a portfolio. Um, we also have index-based investments too, which is similar to that, where it's just a strategy that's based off of an MSCI index or an index that may be bespoke that you're creating, but something that is very quantitatively built and just targeted to a specific part of the market. The last one I'll mention, I think, is personally, I feel like this is the most interesting. It's the impact investing, and that's where that spans everything from traditional investing, but also a lot of the private market side as well. So and the difference here would be the ability for a manager to take the investment strategy that they're implementing and then very directly relate that to the investment, all the investments they're making. So in terms of the impact that they're making in a certain case, so what the mission that they're on. So whether that's a simple example is a climate adaptation, like a climate focused portfolio that is every investment in the portfolio, they will, from a reporting perspective, it's a key element of this. From a reporting perspective, they're able to directly correlate, each holding to how it's impacting the environment, how it's impacting climate, and I think those are the most. Some of those are the most powerful. You get into very nichey areas that people may or may not have, may or may not want to see in their portfolio. But at the end of the day, someone who is really interested in responsible investing, I think it's that impact investing is can really make a big difference. We've launched a a private equity impact portfolio a few years ago, and we're about to launch the fund two of that. And it's again, I feel like it's a very unique part of the marketplace, and it's in an area, especially in the private equity side, where the total return profile is important. Oftentimes, you'll see, I push my team a lot on ensuring that ESG or responsible investing is not just for the sake of ESG and responsible investing. I think some of the most successful strategies in that space have been focused on return as well as doing good for your investors and doing good for whether it's the environment or social equity or some other mission that you may have. That I think they should be equally important instead of just losing sight of the return element. I think both should be on equal footing.
Well, one of the things I'm interested in finding out is the ESG considerations part of your strategy? What happens if a client comes up, the state pension fund says, you maximize return. We don't have any consideration. We don't want any consideration for ESG. You know, do you change is it a different model that you then use as opposed to you're creating a product which some investors, some beneficial owners will say, I want that product because I believe in ESG or I believe in sustainability. How does
Yeah.
that work?
Yeah. So in today's environment, today the way we've built it out is to ensure that we have the right strategies available for any type of client, foundation, endowment, institution, or private wealth. In fact, and that we can build a portfolio either way, but we don't have an overriding ESG in every single portfolio that we create. So that's definitely not part of what we do. If we have if we have an ESG strategy that uses ESG integration, and again, I'll go back to Walter Scott example. We use Walter Scott across the board for our international equity implementation for private wealth clients, institutional clients. They have a really strong strategy, really strong product, really strong strategy, and they integrate ESG into what they do. It doesn't mean every single strategy in a client portfolio has to have that same type of lens on the markets overall. But we do, but we have to have options across the board because we do have clients we have foundations, we have endowments that have asked us, we just want an ESG element here. We have European clients that they just want ESG embedded across everything that they invest in. And we need to be able to build those portfolios, and we can.
How about crypto? Have you been approached developing more products involving cryptos?
I would say that every time crypto spikes, we get more questions about crypto. So yes, we,
They must be busy this week.
ex- exactly. It's a little busy right now, right? Right, exactly. Yeah, we have not built a capital market assumption on crypto. We've looked at that, but we have not incorporated that as of yet. And that's a foundational way to answer that. It may be a little cryptic, but at the end of the day, if we have a capital market assumption, it's easy for us to build a portfolio around just about any of these asset classes. And we've got, like I said, over 50 the different capital market assumptions across different asset classes. To date, we haven't done it for crypto.
How, how do you respond to a potential client who might come in and say something like, we want a ESG type of product, but we don't want to sacrifice returns?
Yeah, I welcome that all day long. I think that's the right way to go about it. Yeah, I feel like if you are if you I almost flip that around a little bit. If you went to a client and said, "We will offer you an ESG portfolio, but you're going to have to accept a discount of 1 or 2%." I find that's an unacceptable response. Like I don't think that's a good response to a client at all. So I feel like we should be going into our analytics when we have a portfolio manager and a research team evaluating strategies, whether it's an ESG strategy or a non-ESG strategy. The goal is to make sure that we're able to outperform. We're able to do good for our clients and build portfolios in the way that should outperform an overall benchmark. And that goes across the board. That's the way the entire team takes it. So I think that it's a great question. I don't know. I'm not sure how many people in the industry. Maybe there are folks out there that are going to individuals saying, you're going to have to take a discount off of what your expectations are just because you want ESG. And again, I find that as unacceptable.
Well, I'm searching for studies that show me that you don't give up returns. But Well, what role does technology and data analytics play in your strategies? Have you adopted these tools under your leadership?
Yeah, absolutely. As I mentioned before, the landscape of just technology has changed so much over the years. There's a technology and the data access that the team has in order to be successful at what they do. We've built that out. So the team has access to attribution analytics. They have access to pretty much everything under the sun, whether in all the different asset classes, to ensure that they're able to accomplish their job and do the best job they can for our clients. That's one element of it. The other part of it is the kind of stitching everything together. The more difficult part of this is, and I'll take it from two angles again. One is just the investment side and our research team. We're every day trying to create more of a data lake, if you will, of information that we can go into and pull information out and create and basically pull it out and do lots of different analytics on portfolio strategies and factors and everything else, which is really important and unique and hard to accomplish. The other side of it too, though, is our client base, and I think in the intermediary side, BNY spent a lot of time, energy, money, um, for our wealth management clients overall to create an interface that does the same thing for financial advisors and investors. So basically, we've done a ton of work around creating something for our Persian clients in particular called Wove that allows us to pull all this data and information right from the custody side of the portfolio, the elements of the portfolio, straight on through to the end reporting, and doing that in a fashion that is seamless and not going you know, you know, from one database to another database, or trying to stitch together 4 or 5 different vended systems, trying to put that all under one roof. That is a huge advantage, and saves a ton of time, and creates lots of efficiencies. So the more we're able to do that, the better. And it's like this constant. You have to be on top of it all the time, because otherwise, whatever you're using is going to be outdated before you know it.
Do you see AI and machine learning significantly altering investment decisions? And if so, how?
So, um, altering investment decisions, not so sure. Um, Playing a very significant role throughout the investment process, 100%, absolutely. You know, it's it's hard to see a world where AI is not playing a really big role in our industry, in financial services. Um, Everything from the most mundane uh, um, market update piece to the more complicated identification of trends in valuation and pricing. All of that, I think, is all of that will come to fruition, if it isn't already, at a lot of organizations. And a lot of this is very far along in a lot of organizations, including our own. And the trick is, and what we're focused on, AI is a big push within BNY overall. And it's it's not where we are looking to AI to make investment decisions at all. But where it really plays a huge role is, when do you, if it can help you with the analytics behind when you have a human doing something versus when you don't need to, right? So it's basically, if you just allow AI to run gamut, you're going to run into mistakes and issues, obviously, and not let alone compliance and legal will take, that's a whole different issue. But if you're able to harness the power of AI, machine learning, and basically, and again, this comes down to data. Gets back to your data question. I mean, it's all about data. Garbage in, garbage out. If you have the right data and a lot of it, that's where machine learning really becomes very powerful. So if you're able to take that and basically use it efficiently and help you manage your team's time and basically scale, that's where AI becomes really, really powerful from our perspective.
Yeah, I mean, the amount of information continues to grow, and more products available to analyze, I mean, I would imagine with a group of 80 to be able to cover all of those markets globally, uh, using natural language processing uh, sort of cuts down time tremendously. I see that. It's not a matter of I see it, but I hear from people talking about that's where its value is, has been shown to exist as opposed to alpha generating. First of
Mhm.
all, if anybody's doing alpha generating with AI, they're not telling anybody. That would be sort of foolish to do. Okay. But by the way, when I was in school, I mean, we were still using punch cards.
Right.
Okay. But the time I graduated there, then I had to learn all of this on my own. And I imagine you had the same thing. When you went to Lehigh, I would imagine they were only up to probably using some optimizations. That was the level of sophistication that might have existed at that time. How do you keep up with all of this?
It's not easy. So well, you know what? I'm a strong believer in the old adage, hire people smarter than yourself, right? So it's yeah, and look, the reality is, and I did not have the pleasure of working with punch cards, but you're absolutely right. I remember working at SEI with a guy who was a PhD who spent a lot of time just with these borrowed dumps and downloads, and my job was to do all the analytics around that with SaaS software and all this other stuff. So, I've always had a bent for the quant side and have loved it. But we are in a whole nother world right now that takes a lot of skill, and it's and I do feel like you really do need to hire experts. We've got a couple of people on the team who absolutely love this, love the fact that love AI, they love machine learning, and they're constantly reading and learning about how to sort of advance what we're doing, which I think is awesome. And you need to have sort of a little bit of that culture within the group and hire people who have that skill set in order to stay on top of it yourself.
Yeah. When did you graduate from Lehigh?
93.
At that time, about a couple of years after you graduated, they made the big push to combine the finance department with the engineering program. They now have that
Right.
quantitative finance program. And a lot of schools have done that. And the reason why I asked that question is, we're at a stage now where the number of analytical tools is increasing. I spend more of my time, focus more time in the journal, and certainly the CFA Institute is really trying to educate people in this area. You have not only in AI, machine learning, you have these things called causal models
Mm.
and things like network modeling. And gee, you have so much time managing a group of people and all that. It's true. It's true that you may hire smarter people, but you have to have some foundation to understand what they're doing. And that's really been a focus now, I think, of certainly my work, and I think the CFA Institute's work is trying to get people up to a level where they understand the foundations without having to be a geek. Okay.
Right.
And that's,
Right.
I think that's where they're going. But let me go on.
Yeah.
BMY serves a diverse uh, range of clients from nonprofits, high net worth individuals. How do you tailor customized investment strategies to meet such varied needs?
Yeah. So, the starting block, and again, not to overuse the word foundation, but the foundation of what we're doing for each and every one of our clients, that's important. Like that there's some consistency around that is really important. So we are speaking to clients on a global basis all over the world, let alone within the US. You've got private wealth clients that are taxable, you've got foundations, endowments, you've got pension clients. But at the end of the day, it comes down to some of the same conversations. It comes down to investment objectives, the risk tolerance of a client, your liquidity needs as like key pillars around how you're building an initial portfolio. And then tailoring the investments comes down to some of these, so the asset classes that are involved in each different portfolio. But liquidity needs is an important question to understand how much in privates, if any at all, would be available. And that's where that's where you're, getting to the nuances of one portfolio being differentiated from others. But again, especially in my seat, my chair, you overseeing a broad scope of lots of different client portfolios. It all comes down to risk mitigation and making sure there is consistency across clients to ensure that, when we're tilting portfolios on a tactical basis, it's being implemented in all cases where clients allow for that. And that things like that are really important.
When was the last time you were at Lehigh?
Yeah. So my oldest son graduated in 24. My middle son started Lehigh this year as a freshman. So I go back quite a bit. and I
Okay,
and
so when
even
you go
before
there,
that, I was going back quite a bit before that. So
okay, well, if you go back there and you were asked to give advice to students who are interested in going into the wealth management field, what advice would you give them?
and I do this every year. Actually, I do go back and I give, and they ask me to talk to different grades, whatever. And the
Well,
advice I give them, there are a couple
let me
things.
cut you off. Lehigh is an outstanding school. I know our local high school here, some of the best and the brightest, will select Lehigh. I mean, what is it called? A mini Ivy?
Yeah,
Okay,
right,
refer to
right,
it in
yeah.
that way, but
Oh, it's gotten a lot
yeah,
better. I'd have a hard time getting in these days. So, compared to when I got in 30 years ago. Um, but look, when I tell these, the people who want to get into wealth or just the industry overall, like the financial management industry, um, number one is to seek out really good mentors. I think that's really important. If they feel like that, having a good mentor, and it's hard to do that when you're young, but you'd be surprised at the willingness that people who've been in the business for a long time have to, if you gravitate to the right people, to spend with the next generation, if you will. I think seeking out good mentors early on is really helpful for people from just throughout their entire career. And you may feel like when you get into our business that it's this big unwieldy industry. It's a small it's a small industry. Like it is a very small world out there, and I think networking is really key. Um, the other thing I recommend, stay curious and stretch outside of your comfort zone. That I think is also important for someone coming right out of school to raise your hand and get a little bit uncomfortable. And people recognize that. Your bosses will recognize that. The last one that I always bring up is immersing yourself in finance and just be an avid reader and then take the CFA, which I'm saying all the time. So you be proud. But I'll tell folks, and I'll get pushback from some individuals in school say, well, I've heard MBA is better, or I've heard CFP is better, and all these other different degrees. And it's probably because I have a CFA, but I've seen it in the industry how important it is and the credibility it brings to somebody who may be younger in the industry. Having the CFA and taking the CFA, getting your CFA is really important. So I'm a strong advocate of that as well.
yeah, and I've heard that controversy all the time, CFA and MBA. I think they complement each other. I don't think it's either or situation. By the way, did your oldest son, is he in finance? What area
No,
did
so my oldest is an engineer. My wife also went to Lehigh, so we're kind of a Lehigh family. My daughter's at Syracuse. I have to mention that in case she watches this.
your daughter
Uh,
is what? I'm
what's
sorry,
that? My daughter's at Syracuse. Go
Syracuse,
go
okay.
Orange. But my oldest is a computer engineer, electrical engineer.
Yeah, it has Lehigh has a great program, and
Yeah.
they, for engineers. And the interesting thing about engineering is they teach you how to think a certain way, and it's very easy to make the transition. That's where I tell a lot of people to take the CFA exam. If
Mm.
you're an engineer and you're interested in switching, I think that would be very interesting. Is your youngest son And your daughter, are they both in the finance area?
My
Interested in it?
my daughter's pre-med. My son who just started Lehigh is in business, and he's leaning towards finance. So he's more
Okay.
he's the finance guy.
Now, how about you? What drives you personally as a
Yeah.
leader in the wealth management space? And how do you stay motivated in such a dynamic and demanding industry?
So I guess I love what I do. I think that it's the at the end of the day, the job is finding solutions for such a wide range of clients. And what motivates me, um, I would say helping people succeed, and that goes both my own team, my group, as well as my clients, right? And if you're in a position where you are able to help people succeed, I think that's really it brings meaning to what you do every day. And I love problem solving. Like that's just one of my I just really enjoy problem solving, and no 2 days seem to be the same, right? So in our role in our job, there's so much diversity in what we do every single day, that no 2 days are the same, and I think that brings a lot of personal gratification to the job every day. And the last thing I'll say, right now across the wealth management industry, it is just such a great time to be involved in this segment of the market. The pace of innovation is huge. It's just from my perspective, I feel like this has a very dynamic opportunity in terms of bringing uh, some very unique investments capabilities to everyday clients and investors. So, as I said before, the democratization of alternatives is a huge trend in the industry, creating great innovation in product development that I think will has we're just at the beginning stages of at this point.
Thank you very much. Take care.